And that psychology is so powerful because we are emotional, especially about our own investments. And that's why I tell clients, like, I'm not emotional about your investments. I'm only emotional about my own.
Right. Hello, and welcome to the Finding Idaho podcast, where we dive into the Boise real estate market. We bring in small businesses, and we just like to talk about Idaho life in general. Today, we have a special guest. This guy, I've known him for 39 years, almost 40. Turns out he's my older brother. So this is Jacob. Say hi for us.
Hi, Andy. Hi, listeners.
Yes. So Jacob is a financial advisor. I'm going to let him introduce himself. Tell us a little bit about what you do in that respect and how long you've been in the business and those sorts of things.
Sure. I'll start with the last part of that first. I've been in the business. I had to look at a calendar. I've been in the business over 24 years, and I've seen a lot of markets, seen some ups and downs. And I started in Portland. It was a temp job. And I got into a mutual fund company, and I kept showing up to work, and they said, how would you like to answer financial questions on the phone?
Right.
And they licensed me, and away my career went. So, and I haven't really looked back. It's been a good process. So the last 7 years, I've been in the financial planning practice. And so that's a shift from, dealing with mutual funds and other things in the previous environments, because now I'm really counseling businesses and families, and specifically most of them local here in Idaho.
Very nice. And who do you work with?
So I am now in an independent planning practice. We call ourselves Wealth Management Associates, and the majority of us are based in Eagle. So there are 9 of us practitioners all together in an office, and we've got over 1,000 clients between us, and it's a great business. We really enjoy it, and especially the clients that we get to serve over a long period of time. We build deep relationships, and they just end up in a better financial position.
Sure. So as we typically do these, we put out the day before we're going to record on our Instagram stories for people to ask some questions of our guests. So we've got a few questions that we're going to go through. I want to talk just a little bit about some generalized things with you too, of course. The question that we got from our Instagram audience was just looking for advice during all of this volatility. It's no secret. Obviously, this last week has been pretty crazy. I think it was Monday that was kind of the big bombshell that hit. And it also was in the mortgage industry, with real estate where I'm at. So people just kind of looking for, a little bit of your thoughts in that realm. So take it away.
Sure. Yeah, we're halfway through 2022, and it's been volatile. It's been more volatility than we've seen in a while. We're officially in a bear market, and for those that don't know what that is, that means we're down more than 20%. On kind of the major indices. And that doesn't happen very often, thankfully. It's once every 5 to 7 years, somewhere in that range. And, we're in this time period where we've seen a lot of rough economic news, lots of inflation, interest rates are rising. And typically the stock market in general, is always ahead of economic reality. So what that means is the sell-off actually started many months ago, and it's just kind of gotten to a certain point. Now, what happens at some point is it finds a bottom, right? So then the question always is when, right? And I don't have any clarity on that, any more so than most. But I can tell folks with confidence that it does find a bottom.
Sure.
And the market never tells you when it's done. It just goes back up again.
Right.
And sometimes the stock market will be going back up even when more bad economic news is coming out. And people wonder, okay, what's happening here? Money only can go so many directions. Businesses that are profitable might all of a sudden look really attractive. Same thing happens in real estate. And I think real estate's a good example of this because it's real tangible, right? And so in this Idaho market, we've seen prices really go up significantly in the last few years. And I think if prices begin to come down, there's a certain point at which it becomes really attractive again.
Sure.
Very attractive. And more buyers come back out. And so I think patience is the biggest virtue, right? Is
Sure.
to have some patience. Also have a good strategy.
Mm-hmm.
I'm always thinking, how do I take advantage of this market, right?
Sure.
And that's the conversation that I think good planners have with their clients, which is what's the right time and timing to actually put more money in the market.
Mm-hmm.
I had a client call me yesterday and say, hey, now is now the time. I'd like to send you more money to put in the market.
Right.
And that's the right behavior because at a certain point, you are buying at a discount relative to where it will be in the long-term future.
Sure.
And people that do that never are disappointed.
Mm-hmm.
So,
Well, and I think a lot of times, both with real estate and similarly in stocks, we focus, so much on what that value is, currently, or what we say it is.
right.
But truthfully, an equity in your home is no good unless you sell it, nor
Right.
is
Right.
being upside down in your home terrible for you unless you sell it at
Right.
that point in time.
That's
And,
right.
Same with your stocks. You go out and sell everything right now, and it's
Yeah.
probably a bad move.
That's when you've actually locked in your loss. And I use a real estate example all the time. Is real estate does move. It does go down, at times too.
Sure.
And in the stock market example, you might be down 20%, and we always remember the high water mark.
Mm-hmm.
That's burned into our minds. I had $1 million of something, and
Right.
now it's worth 800
Right.
thousand.
I lost.
But is that the right time to go sell it?
Right.
I mean, who in their right mind, if you didn't have to sell your house, would go put their house on the market when there has been a downturn?
Sure.
Same with stocks is that, if you're in a high quality investment or if you're in a, high quality real estate investment, why would you rush out when prices are ugly and everybody's putting their house on the market and go do the same thing? You generally want to do the opposite
Right.
of what everybody else is doing. And actually what the media is telling you to do. So sometimes you have to turn the TV off.
Sure.
But I think you brought up another interesting point was, in a situation where maybe you have an estate, and you need to liquidate something, or you have this idea that, hey, I've got $1 million house, but I'm living in it. And I always tell people, they're like, hey, it's a good time to sell. And I was like, yes, but you'll be homeless.
Right.
So
I've had that conversation with a lot of people.
So you have to buy something somewhere unless you're going to live with your children or,
Right.
move back in with your parents. So if it's your primary house or if it's your retirement income engine that's going to give you retirement income someday, you need to look at it this way. It's there to produce income or it's shelter. And that number that we produce on people's statements, that's what your kids get when you die.
Right.
That's it. Because all you're going to do is use that money
Right.
or use that house or use the income from those things to live a certain way in retirement. So I think the important thing to remember is when you hit this high water mark of whatever it is, if it's $2 million or $1 million, don't get too emotionally attached to that number because it's going to change.
Right.
It'll go down, it'll go up. And if it goes up higher than you expected, great, but that's the number your kids get when you're finally gone.
When you're gone. I tell people that a lot. I find myself having a conversation about, our primary residence a lot in that way where, I think we've done ourselves a disservice as society where we talk about that primary residence always as an asset. And it's like, well, it's shelter. And
Right.
it's certainly easily, we can say, yes, it's better to buy and pay off a mortgage than to rent, all of those things. But it's an asset for your kids.
Right.
Or forever, whoever's going to
Sure.
inherit it. Because,
Sure.
At the end of the day, I can go sell my house right now and have a lot of equity and then dump it right back into another one, right? Because
Right.
I got to have a roof over my
Right.
head.
Right.
Nellie's going to be a little upset with me if I sell our house and,
You better
and we
not.
don't have another way to go.
You've worked hard on that house. I think you keep it.
Seems like a good idea.
Yeah.
But, it is. It's not really an asset. It costs money
It
to
is.
live there. And,
It does.
And, we're replacing the windows this month, and that's a lot of money.
Right.
that we're-
Right.
So it's not an asset. It's not bringing in income. It's
Correct.
giving us a place to
Correct.
live. And
Yeah.
over time, that should be a little bit of a nest egg for our kids at
Someday.
some point, which is great.
Yeah.
Good for them.
Good for them. Right. How's that help me now?
Right.
Well, and I think I tell my clients, you can own another piece of real estate, and that does become
That becomes an asset. Absolutely.
That's definitely an investment. It's definitely an asset. It might provide income or give you some future benefit, but just repositioning money into different forms of equity, you're really just asking yourself, how is this going to behave over time, and what is it for?
Right.
The other comment I'll make is I've had people think, well, I'll sell my house and I'll downsize. I haven't seen a lot of real statistics on this, except for what I've experienced as a planner. Probably 7 out of 10 times, a client actually goes lateral or they upsize.
Right.
So people say, I'm going to sell my house, take my equity, buy something smaller. Now, I do see that happening late in life. A lot of times, if clients elderly, they're getting older, they have a big house that's a lot to maintain. It's more of a lifestyle issue because they need something simpler, smaller, and so sometimes that can happen. And we can look at that as actually creating a certain amount of repositioning equity from the house and into something else that does provide income.
As long as you're actually
you have to do it.
That.
You actually have to follow through. Yeah. But I've also had people call me and say, "Well, I didn't actually downsize."
Right. Well, and a lot of people they do that, or they might downsize in the sense that it's less square footage, and it does fit those, but it's all of a sudden a higher end
property
home, and property, and it's it's
okay.
more luxury, which is fine if
that's your choice.
What you want to do.
Totally.
So I actually had somebody else ask similarly to this because we were kind of talking about real estate and. Just a lot of people right now, of course, have been moving up from California. Talk just a little bit. This guy was kind of saying, well, let's say hypothetically somebody sells their house in California. They make $800,000.
Sure.
They come up here. Would they be better off buying a house and paying cash for that home, or maybe, obviously there's certain numbers where the mortgage works out better, but still taking out a mortgage on that house to a degree and then either putting the rest of that into another income property or into stock market stuff to actually generate income or, just kind of, and I know it's difficult to answer that question without knowing the other specifics of that individual person, but, speak to that a little bit in general terms as best as you can.
Okay. Yeah.
Good luck.
You're right. Thanks. It's going to be hard to answer in specifics because I'll give you, here's a few guiding principles though. Because I'm going to want to know what other forms of, investments do they have? Retirement money do they have? Are they completely retired or partially retired? There's just a lot of things to kind of look at in terms of their specifics.
Sure.
It's okay to have a mortgage or a small mortgage. Now, I'm not certain I'm excited about it in this mortgage market.
Sure.
Right? So I think sometimes
now they're just over 6%,
Right. It's a different environment. And I don't like my clients taking on risk, extra risk that they don't need to take. Right.
Sure.
And so I think, especially something as important as your home and your home equity, I'd want to know that they've got other guaranteed forms of income to cover that mortgage. I'd want to know that they've got maybe they're still working or there's a lot of other scenarios here. I did have a client as an example who, he was worried about taking out a really tiny mortgage. And so we did his numbers and it just made a lot more sense for him at that time to take money out of his mortgage rather than take money because his alternative was to take money out of his IRA and pay some taxes on it. So there's these things once you kind of lay the whole thing out, sometimes it makes more sense. But that was the house. That was the other thing. It's like he was looking at all these options and he's like, unfortunately, based on the local prices, I was hoping to get a house for X and I can't. I'm not finding what I need. And so I'm going to end up with a $100,000 mortgage. Now he's still working.
Right. No, he's in a good spot.
He's fine. Yeah,
sure.
He's totally going to be fine. So I think everybody's going to have. I'm going to have a different answer. I think depending on that formula of things. But I did teach the Dave Ramsey courses for years, and I hate debt. I don't want my retirees in debt. I still see people that have consumer loans, taking out loans on cars, and I just, ugh.
Makes you cringe just a little bit.
Yeah, because it just, again, it's a risk that they don't need to have, and they certainly shouldn't be putting money into an equity investment like a second house or the stock market, until they've addressed the debt.
Sure.
That consumer stuff.
The consumer debt particularly.
Yep. Right.
Makes sense. So you've touched on it, just a little bit as far as the, real estate and income properties and things that way. You don't deal with that portion of it necessarily yourself, but you're still advising people in many respects.
Right.
Talk to us a little bit about kind of diversifying your portfolio, especially, obviously as it relates to stocks alone, but then what are your thoughts on having that, rental income or whatever it might be as a supplication for retirement as well?
No, multiple streams of income is where it's at, right? If you can have, a little bit coming from Social Security, if you can have a little bit coming from your retirement, if maybe you've got a little pension, if you've got some income producing properties, it's wonderful when you've got multiples, right?
Sure.
And then even inside of those things, when somebody, comes to me and I look at a portfolio, sometimes if it's an investment portfolio, I'll see maybe we've got opportunities to diversify this quite a bit more. I think the same with real estate. Like, you can get too much of a good thing. You know? You can have all local apartment complexes, right? And that might work okay for a certain market or for a certain period of time. But it's great when somebody has even investments in different locations or types, because that diversity, while you might do really, really well in one period of time, you just open yourself up for risk in a different time period where there's a massive shift, right? And I'll give an example real specifically. I've had clients that have put a lot of their portfolio, when they put it together, in technology stock, right? And if you've done that over the last 4 or 5 years, you're really pumped, except for this year.
Except for now.
Except for right now. Those same clients are down, on those investments, 35%. Whereas they didn't necessarily need to be down that far if that was their, thing they were holding on to. So I think, I preach that we're going to have diversified portfolios. We're going to invest in things that hold value in the downturns. And multiple streams of income really does work, because if something happens in one of those, your ship's not going to sink. Right.
That's fair.
Yep.
I like it. Okay, so switching gears just a little bit here. When does somebody, obviously the sooner we can plan for retirement, all of those sorts of things, I think everybody knows that's better, right? But generally speaking, what are some things that people need to have maybe in order or be in a certain place? When is it time for somebody to come and get, a financial advisor that can kind of help plan for retirement and, all of those things?
Right. I think when things start getting complex, right? When someone has actually, you have some assets, you have a 401k, you have a few things, and you start to look at what you're managing, and you start to feel either overwhelmed or stuck, or I know I should be doing something better here, right? Because a lot of it is about decisions. I think sometimes I'll get a hold of a portfolio and they'll have great investments, but they haven't made good decisions.
Sure.
If that makes sense. So meaning when to put money in, or what to do with it to save on taxes, or they've just kind of let it sit and they haven't been proactive with how it's behaving. And every client I've ever worked with does better when there's proactivity around it. And that's what a financial planner is going to help you do.
Right.
It's kind of like having the coach.
Sure.
Or the person that you're going to have to, sit down with and have a conversation about all of your financials. And sometimes it's your insurance plan is bad.
Right.
Sometimes it's you don't have a estate plan written yet. It might not always have to do with your investment portfolio, but those conversations lead to decisions that lead to better outcomes
Sure.
for everybody. And so I think when you get a sense that you are dealing with multiples of things that are, most people can handle basics. Not everybody can,
Sure.
but that's maybe overly generous, because some people it's working on budgets and working on, just make sure you know what you're spending. And I think there's a certain level of value you're going to get from having somebody that's going to look at your whole picture and say, here's what I think we should do next, and help you with that. And some people also, the actual picking investments is overwhelming, and so they don't.
Sure.
And so when somebody needs that guidance, that's a good time to start interviewing somebody.
Sure.
And building a relationship, with a financial planner.
Well, and it would seem that a lot of those decisions are very emotional decisions in many respects.
Right.
And, when we get too emotionally involved in a situation, sometimes it
Bad
doesn't work
stuff.
out real well for you, because you're looking at, for example, what the stock market's been doing, this week and this year, and, and you can have a tendency to panic.
Right.
Whereas maybe having that that coach, that financial planner that can sit there and go, nope, we're okay. It's, and talk you off the ledge, even though it's stuff that we all know in that sense that, the market's going to go back up.
Right.
It's going to,
but we behave badly.
We behave badly.
Yeah.
Exactly. Well, and we easily forget, how, those sorts of things. That, you're in the heat of the moment.
That's
and
right.
You flip.
Well, there's a couple of really interesting studies out there about, investors that buy things online themselves and the do-it-yourselfers, and people that work with a financial planner.
Sure.
And when they studied groups, they found kind of a real surprising result. And most people would say, well, people work with a planner, they get better investment results, but it was almost double. With every group they looked at, and they're like, okay, that's a significant number.
Right.
And then the people working with a financial planner are also paying a fee to work with, and they're still almost getting double. And you're like, okay, wait, now what's going on here? Then they started trying to figure out why. What is the why? And then this isn't true of everybody that's a do-it-yourselfer.
Sure.
Okay, so there's probably people in that group that are doing really well, and they don't need a planner.
Right.
Because they don't mind reading, they don't mind researching, they love it.
They can be disciplined with it too.
That's the key. And that, when they started looking at what was driving those results, there's a few groups they could kind of stratify when they looked at the data, and one of them was, investment selection certainly is important. Diversity, right? Because sometimes people would pile it all into
one thing
or a couple things, that looked the same because it did well last year, right? And so, or their buddy at work told them to buy it. And that was one kind of factor. But the other one was really about the discipline, because I think what happens in downturns is people get emotional. They look at that number and they go, well, I'm responsible for this. And the guy on the TV is telling me this is going to get worse. So I better get out.
Get out now before.
The problem is they might say, I know this is the wrong thing. I'm going to wait 3 weeks. Well, if it's worse,
is even worse than it was.
Totally. So they're like, and that psychology is so powerful because we are emotional, especially about our own investments. And that's why I tell clients, I'm not emotional about your investments. I'm only emotional about my own.
Right.
So I have to eat my own cooking, right? I have to also behave well with what I have in front of me with my own investments. But I think another important thing that I do with my clients, and I think good practitioners do, is I won't invest my clients in anything that I wouldn't put in my own portfolio or don't already have.
Sure.
Right. And that also matters, is the quality of what you're putting in there.
Sure.
Because there are some bad ideas out there.
Right. Yes, absolutely.
Yeah.
So, but even in those cases, I mean, let's say the guy that, does want to have a lot more hand in it than the average person, they can still come to you and say, hey, I don't care if you think it's a bad idea. I want to put, all my money into this, right now. Let's do it.
Yeah.
I mean, obviously, that's a bad idea, and you're going to be advising them against.
Right.
But maybe a certain amount, like, hey, let's take a chunk and do this. And
yes.
okay.
I do. I do take every client's very different, and I do personalize it. And some I do ask that question: how involved do you want to be? And some are at one end, some are at the opposite.
Right.
Most are somewhere in between.
Sure.
Typical bell curve. But you do find there's people that would like to, some of them say play with their portfolio or make their own suggestions. Or I'll call them and say, here's what I'm recommending. And they'll say yes, no, and let me think about it. And I think all flavors work well. The ones that I think don't do as well is the ones that won't take any advice.
Sure.
Right. Because usually if I'm being persistent, and I'm a fiduciary, which means I have to act in client's best interest.
Right.
Which means if it comes to it, I might have to fire myself.
Sure.
Especially if they're not taking advice and they're paying a fee.
Right.
Because that's really what they're paying for.
Is that advice?
Right. And so then it's very apparent at that point that we haven't built that trust that's necessary for that to be a working relationship.
Right.
That's super rare.
Sure.
But it is funny you say that, because I have given trading capability to a couple of my clients, and it's a fun sport to say who's doing better.
Right.
And every single one of them
sometimes.
I'm doing better. So I'm always like, see, that wasn't a good idea.
Right.
But there'll be a time where it'll shift, and it's fine. But I think people want to be involved. It's a psychological thing, because I think it is their choice. I always tell clients, this is your money, and I want you to feel comfortable and confident about the decision you're making, because it's not my decision.
Right.
At least at the end of the day. Clients that have said, I want you to manage it, well, they've kind of delegated those day-to-day decisions.
Yeah.
But everybody is very different in how they feel.
Well, and, we've had this conversation where, I tend to not, it's just, no, you just take care of it, manage it. But that being said, I take a little bit of each commission check and play. And, it's worked out well sometimes, and it's worked out terribly sometimes.
Totally.
Yeah. But it's
you're learning.
Then money that I get to play with, and I get to have fun, and it's a game, and it's also money that I'm not counting on that working out for me.
Perfect.
Because that's a bad idea.
Well, perfect. And I think every one of my clients that we have that arrangement with, it's the same. I say, give me your serious money. Give me the money that you can't afford to live without someday.
Right.
That's what I'm here for, right? Is to help you not make a poor decision. And a lot of times when I'm working with husbands and wives and spouses, there's one person that goes, "Oh, thank you," because they're nervous, right? Because I've been telling him for years that we needed to, do it differently, or vice versa. Sometimes she's the aggressive one, and he's the nervous one, and so it's fun for me working with couples in that, because I'm actually working with two personalities here, and they're it's a joint plan, know, and so I think there's some complexities in there. Nobody told me this, but it's a lot more psychology work than technical analysis. You can be a good technologist and a really poor financial planner. I like just enough of that nerd stuff, but I really do like that, working with them to help
the
make
people and the relationships
to come to a good decision that both are happy with.
Absolutely.
So
awesome. Okay, so we are about out of time, but real quick before we go, what are just a few things that people ought to be maybe looking for, asking questions when they're looking for a financial planner? Obviously we want everybody to come and talk to you if they have any questions or anything that way. But but what do they need to ask? What do they need to be looking at?
Yeah, I think some of the things you should be looking for is someone who's a good listener. And someone who asks good questions. And if I could just say, basing your decision on those kinds of things are really important. I think having a recommendation helps sometimes if there's a couple people you trust, or your CPA that you trust, because they have a vested interest in making sure you've got a good plan.
Right.
They're not going to recommend somebody they think is going to steer you the wrong way.
Sure.
So good practitioners know other good practitioners. So if you've got a good attorney or a good CPA and you're just looking for a recommendation, you can start there. But really pay attention to how the sophistication of the questions they're asking, because I think that matters.
Sure. I like it. Wonderful. Well, hey, awesome to see you, of course. And thanks for coming on.
Yeah.
Any of you listening and watching, give us a subscribe and a like. And if you have any questions at all, don't hesitate to reach out. And, Jacob Coleman with Wealth Management Associates over in Eagle. So if you have any questions for him, certainly connect with him. And we'll see you guys on the next podcast.
Thanks.